As promised, here is our bank reconciliation. This is something you may be familiar with from FAR as well, because guess what? We see it there. You could see a bank reconciliation sim on FAR as well as on Audit. I would definitely be aware of this. Now, what are we going to do here? What is this? What the heck's going on? You might be freaking out. Don't freak out. Don't panic. I'll walk you through it. Kind of like how we have debits and credits that match up, the balance for the bank and balance for the books, well, adjusted balance should equal each other. We should have, let's say, $1,000 and $1,000. Now, how do we get there? Because the original unadjusted balance, so if you log into their bank account or send a confirmation, the balance might be $1,200. So you see it's a little bit more. It's 1,200. And let's say you know that it should be $1,000 at the end, or maybe you don't. You're trying to reconcile these. And then maybe for the books, it actually only lists $900. And you think, okay, damn, these are supposed to equal each other. And in reality, they don't equal each other. And that's the process of this is you're trying to account for anything that what I'll say this party doesn't know about or this party doesn't know about. And what does that mean? These are going to be different reconciling items. Now, let's say the books, right? The books obviously need to be constantly updated because the bank knows everything. What I'll say is the bank's always right. The bank, because the bank is the entity receiving the money, right? This is just the general ledger. This is your accounting software. This is the bank. The bank is the one receiving the cash and sending the cash out. So that's something to be aware of. Now, what we're looking at here also, this is not the bank statement. This is, and this might be confusing to some people, but I want to make sure it's clear because this was confusing to me when I started accounting. This is the balance for the bank in the books. I'll repeat that again. This is both of these are in your books, right? This is your bank reconciliation. So the reconciliation, this whole thing is a part of your books. It's part of your financial reports. And this is what you have as the balance per the bank in your books. So you're not editing what the bank has. The bank is always right. The bank has their balance. You're not going in and changing what they have. But what you're doing is you're taking this template, right? You'll have like a nice template for a bank rec. And you're going to say, here is the balance from the bank on that date. This is 12/31, right? Let's just say 12/31 as of 12/31. This is how bank recs work. It's as of the end of the year. And the point of this is you want to make sure you reconcile and make sure that both of these amounts add up. And if they don't add up, you've obviously got some issues. You want to look into what could be going on. So this number is pulled from the bank statement and you put it into this template, which is in your books. Now here, what do the books not know about? Let's jump over here. Well, at the end of the year, maybe you earned some interest on your cash in your bank that the money was just sitting there. So you earned a few percent interest. You got to update your books because the books don't know about that, right? The books are, there's not, I mean, maybe you have an automatic feed or something. Obviously, if you worked with QuickBooks, you know there's sort of an automatic feed that links to the bank. But your standard books, you want to update this. So maybe we earned $50 in interest. So you see right away, we had $900 listed as the unadjusted balance of cash in the books. But we're just slowly going to meet up at our $1,000 amount, which, that's kind of me looking into the future. I'm just telling you it's $1,000. Any bank fees charged, and you'll see that, possibly on the exam. Fees just for maintenance of the account or late fees or anything, or low deposit fees. So, maybe it's like $25 there. Any auto or electronic deposits that you need to personally go in and look at, because when you receive a check, you are going to record that in the books and then you're going to deposit that in the bank. Now, for example, what are things that the bank might not know about? And this is the mentality you want to have when you're thinking about a bank reconciliation, is what does the bank not know about and what do the books not know about? Well, let's say it's 12/31, right? It's the last day of the year and you receive a check. So on the books, you write that check, right? That's going to be this outstanding checks, or sorry, deposits in transit. So you're going to say you received a check for $100, but the bank doesn't know about it because it's 12/31. Maybe you haven't got a chance to deposit in the bank yet, but you want to make sure that the balances as of 12/31 match up. So here, you received the check in your mailroom. You haven't deposited it in the bank yet, and maybe even if you did, it still is not going to process till the next day. So we received a check. We want to include that because the bank doesn't know about that. Now, outstanding checks. If you wrote a check, let's say we want to pay for something, so we're spending $300 on something, and we wrote a check. Now that's money out the door, right? And we are going to record that in the books. However, the bank doesn't know about that because, well, if you're not familiar with how checks work, because I know more and more these days, obviously people aren't using checks. If you're not familiar with how that works, well, you write the check, And maybe it's not till 2 or 3 months later, 2 or 3 months later, the whoever you wrote the check to cashes it. The bank is not going to take that money out of your account until that person cashes it. So outstanding checks, you would write 300 here because that's something the bank doesn't know about. Is that someone at any time could just pull $300 out of your bank account? That's again just why are we including these? These are the main two items that the bank is not going to know about because, like, how would the bank know about that? And lastly, here we have the bank errors. You might just see a question where it's like, oh, we have a bank error, right? And you need to adjust the bank balance. Usually, the bank's always right, as I was saying. So these are going to be a lot less common. But just for the sake of getting our balances to $1,000, right? So add that. That's 1,300. So minus outstanding checks, that brings us to 1,000. So $1,000 is our ending balance here. That was perfect. Worked out very nice. What are some other things? Obviously, errors as well. You'll see commonly on both FAR and on audit. You might record, so you might have an entry where you tried to record an amount for $128, but someone accidentally recorded it for $182, right? Just a little numerical discrepancy there. So you would obviously adjust this balance by the difference. Return checks, any checks that bounced, auto electronic payments, check printing costs, not something you'd see particularly, but it's there. But really, let's just say we are going to add an error, right? We add $50 from somewhere, brings us to $1,000. That is the process of reconciling because these two should match. Now, again, in reality, they don't match, but you're trying to look through all of the items that are making them not match and bringing them together. That is the riveting process of the bank reconciliation. Now, one last point, you could see bank checking account number. You could do this for multiple accounts. Let's say you have 4 different bank accounts. You could do them all together. You could do them separately and then bring them together. I've seen some crazy cash and bank reconciliations in my day. It's absolutely wild. If any of you have worked with some cash recs in the past, that's supposed to be the normal easy beginner thing for an associate to do, but seen some that even managers have struggled with. Stay strong out there and prepare those reconciliations best you can. Let's talk about testing when it comes to the bank rec. So, like we said, that is the bank rec, and that is prepared by the client. That's prepared for each company. Super important to do, and it's your job as the auditor to test that and make sure that they did a good job because they're doing the work. They're reconciling the cash account, and hopefully that agrees to what you see on the financial statements, and that's what you see in the bank. And if that's great, you still need to check the work. So the auditor has the responsibility to test the year-end bank reconciliation in order to gain comfort over the year-end cash balance, internal controls over cash, because preparing that bank reconciliation is an internal control, and the cash cycle as a whole. Bank recs are the primary evidence regarding year-end cash balances in the financial statements. That's very true. Like I said, it's bank recs and confirmations. Following procedures would be performed in testing the year-end bank rec. What are we going to do here? We're going to agree the balance per the bank on the year-end bank reconciliation to the balance per the bank confirmation. Shocker, right? Using that bank confirmation. Absolutely shocker. I know you're probably like, oh my God, I didn't see that coming. Next, agree the balance for the books on the year-end bank reconciliation to the general ledger. So this bank rec is its own document, right? It's its own report. And what you're going to do, those two numbers, those $2,000 first, or actually the unadjusted balances at the top, you're going to want to compare that to what you see in the bank confirmation. And then you want to agree the balance for the books to the general ledger. And if those look good, I mean, that's a first step, make sure those look good. Then you want to foot the bank reconciliation and list of outstanding checks. You want to just check it for mathematical accuracy. That's really, I think, a good way to summarize that. For cutoff purposes, you want to agree the deposits in transit and the outstanding checks to the cutoff bank statement. You want to make sure that those reconciling items that they listed are legitimate, that you can actually find them, right? They are true. The cutoff bank statement, it's obtained from the bank by the auditor, and it covers the first 10 to 15 days of the period after the end of the year, right? Like I said, this is a statement created for the purposes of checking that cutoff, and will cut off, but generally within 10 to 15 days is when you're going to see normal reconciling items that one party hasn't found out about. Now, like I said, you can have a check that's been outstanding for 60 days and someone just hasn't cashed it, but that generally is not the case because if someone gets a check, obviously they want to cash it as quick as possible, get access to that money. And if there's a check that's been outstanding for quite a long time, you can actually write that off. I'm not going to get into that because there are different policies and procedures on how that happens, and it's past the scope of what we do. But if a check's outstanding for such a long time, you can essentially count that as money that you will not end up having to pay because maybe they lost the check, and it's their job to come to us if they lost the check. Any reconciling items should clear within 10 to 15-day period. If any item does not clear, the auditor should investigate and collaborate with the client to understand why. Like I said, if that check is outstanding still, or if there's a deposit that hasn't cleared, it's usually going to be just some issue, just something you can easily work through. But the process and the purpose of this is to understand why was this outstanding for such a long period of time. Here is a nice little example that we could see. Like I said, this is something that I've seen on FAR and something I have seen on audit. So making sure we're familiar with this here. Poland Corporation had a balance of $200,000 in cash on its general ledger at the end of the year. And additionally, we have these reconciling items. Now, first, I'd say, what are we dealing with? We're dealing with, okay, the book amount. What's the cash balance we should report on the year-end balance sheet? So this is just reconciling the year-end general ledger amount. This actually isn't even dealing with really the bank at all. I mean, obviously, we will have bank amounts, but we just want to adjust this $200,000 amount, and let's see what we're dealing with here. Well, first, a $17,000 check to Poland dated January 2nd, year two, that was not included in the December 31 checkbook balance. And remember, the goal here is we want the December 31 year one balance to be accurate. So only items that should have been recorded as of that period should be included. Let's take a look at what we've got here. So what are we going to do? We're going to ignore that 17,000, right? Because that check was dated for year two. So it should be applied to year two. And as such, we don't even see it here because that's not something that should have been recorded at the year one end date. Next, we have this 5,250 check payable to Poland, deposited December 22nd, and included in the December 31 checkbook balance, which was returned non-sufficient funds, meaning we deposited it, someone gave us a check, we deposited it, and it bounced. And what does that mean? It means that person did not have the money in their account to pay us. So the bank says, sorry, you're going to have to go back to that person who gave you the check and get another check. However, the check was redeposited January 2nd, year two. What likely happened here is when you tried to deposit the check, you contacted the customer and said, hey, the check you gave us, it didn't work. So they say, oh, dang, we don't have enough money in our account. Let me deposit money in our account. They say, try redepositing it January 2nd, year two. And then it cleared January 7th. So what is going to be the treatment there? Thinking about it for a second. Well, the money was originally included in the $200,000. Why was it included? Well, because when we received the check, the accountants would have included it in the general ledger balance. However, it didn't actually get itself into the bank account until year two. Because even though, we think about it, right? Even though it kind of applied to year one, this is like cash basis account. We're not worried about accrual basis. We're worried about what's the actual balance of cash at any given time. So this 5,250 amount didn't get into the bank until year two. So as such, we're going to subtract it. And again, why are we subtracting it? It's because it was originally recorded when the check was received, even though it didn't have enough money in the account yet. We didn't know that at the time. The accountants had recorded it, and that was part of this 200 balance. So we're going to subtract that out, and we're going to apply that to the year two balance. So this would be, in addition to the year two balance. So we subtract it from year one, add it to year two. Lastly, let's look at our item here. This $32,000 check payable to a supplier and drawn on Poland's account that was dated and recorded December 31, but not mailed until January 15, year two. You see just common possible items that need to be reconciled because they are in that cutoff period. They're in that period that's 10 to 15 days before or after year end, where obviously we get a little funky. We have things don't clear right away. We have to deal with it. So what are we going to do here? It was payable to the supplier and drawn on the account, meaning it was taken out of the account, right? But that was dated and recorded December 31, but not mailed until January 15, year two. What are we going to do there? Well, we are actually going to add that back because this check, it says it was drawn, meaning we recorded it down, meaning we subtracted out 32 on our books because, well, we're expecting that money to leave our account. However, in reality, what happened, if we read back here, it was not mailed until January 15th. So that person didn't even have the ability to take that money out of our account yet, until year two. So as such, we should not subtract that $32,000 out of our balance until we have a year two balance. So we're going to add this back. So let's just recap again. We start off with 200. We did not include that first amount because it didn't happen until year two. This 5,250 amount, this really didn't affect us. We didn't get this money until year two, so that would be included in the year two balance. And then this we originally deducted because we assumed we were going to pay it out, but we didn't actually send this check until year two. So the person we sent it to did not even have the ability to take it out of our account until year two. As such, it would not be included. It would not be a subtraction from year one. So we are going to add that back. Nice example here. Keep practicing and having a good time. Let's talk about if we got a few items that relate to cash that you can see questions on. What is a bank lockbox system? And this is a term you may see. Comes up in questions. So using a bank lockbox system, customer payments are sent directly to a post office box owned and operated by the bank. So instead of you receiving your checks or cash in the mailroom, which is how we've talked about it so far, which is a totally legitimate way of doing business, but this is an additional method. This is an additional way, and we'll see the pros and cons of it. The bank, let's say you use Bank of America. Bank of America has a specific post office box that you have your customers send the checks and cash that they owe you to. So instead of sending it to me, they're going to send it to my special box. The bank then collects the payment and deposits directly into the company's account. So I never touch it, but it goes into my account, right? I never have my employees for my company touch the cash. Because of this, it eliminates the need for an employee to physically touch the payments and reduces the risk of embezzlement. Now, obviously, you might say, well, what if the bank's employee, embezzles the money? Well, that's a different issue. I mean, obviously, it's on the bank then. It's not on you. And as such, you also are going to have checks. You're going to have ways to monitor your cash, and you should have received that. So if you don't see it in your account, but obviously, at this point, I think the bank has it a little bit under control. But now that being said, there is a lot of fraud out there, so I don't know. But just kind of going through how this lockbox system works. The bank is also responsible for reconciling the payments and sending the company a daily report of all payments received. This system is commonly used by companies that receive a high volume of payments, such as utility companies, insurance companies, and retailers. So what's the benefit here? The benefit here is that it's going to reduce the risk of embezzlement. It's going to reduce your liability because you don't have to worry about your employees possibly mishandling the funds. But obviously, you can check, like you've got the remittance advices that you can compare against your balance. So, if someone says they paid you and you don't see the amount, then you can say, hey, bank, we should have received this. Where is it? So just different pros and cons. Obviously, you need to pay for this service. It's an extra service that the bank is going to give you. They're not going to just give this to you for free. I don't know, unless it's part of a big deal that you did with the bank. So just something to keep in mind. This is a concept that we will see. You also see this on other exams as well as a concept. So make sure you're familiar. Standard bank confirmation requests. We talked about this obviously as a very important audit procedure. Now let's talk about specifics of it. Bank confirmations and an audit of the year-end bank rec are the primary procedures for testing the completeness, valuation, allocation, and existence assertions for cash. Remember, it's pretty much everything except cutoff, right? Doing these two things are the way you'll test most assertions for cash. The standard bank confirmation should be sent to all banks with which the customer has had dealings in the past year, even if there's no year-end balance to confirm. So even if they say they have $0 with JP Morgan Chase, you're still going to send them a bank confirmation if they have an active account with them. This is done to provide validation of the year-end amount, as well as proof concerning loans, potential liabilities, discounted notes, pledged securities, and guarantees or assurances. So you could have, again, like I said, you could have a lot of other financial transactions with the bank and obligations with that bank. And on this form, you're going to ask if any of these other situations exist.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.